Welcome to the All Financial Hour podcast with Steve All.
You know, the stock market really up until earlier this week was really doing quite well. The summer months in midterm election years have often been a rough stretch for stocks. Many are wondering if we're going to see the same pattern this year. So what has history shown us, and how do you help clients avoid making the wrong move at the wrong time, Steve?
Well, I think that a lot of it does roll down into that. There used to be the old saying, sell in May and go away. And that was a lot of that was built around the days in which teachers only got paid 9 months out of the year. So when those teachers' payments stopped, there was no contributions to 403Bs during the summer months. So there was less buyers in the market. So that was one of the things around it. And it is true. Most midterm elections, there's usually a change in power. If they've got everything, like right now, they might lose the House, they might lose the Senate. They might maintain it all, but it causes uncertainty. And uncertainty is the things that cause the ups and downs in the market. So the question is, how are you doing? What are you doing to protect the gains? The market's been up pretty good over the last 2.5 years. So what are you doing to protect those gains? Well, Joanne came in. She had about 1.8 million, and her concern was is she did not want to have another 2000 to 2002 experience or a 2007 to 2009, those years of those great big declines. So we looked at it and we sat there and talked. We got a couple different ways that we can look at this. How do we protect those gains? How do we lock in those gains? And we looked at it. You know, if you're in that situation, we can look at it and sit here and say, let's move a portion of your assets off the table. I like the fixed indexed annuity for protected growth in this instance. Give me the right tool for the right job. But I want protected growth. I want to lock in those gains. If the market declines, the annuity is not going to go down in value. If the market goes up, it's going to participate in it. So that's one thing that we can do. But some people just say, Steve, I really don't want to use an annuity. And I'm okay with that. I think it's a great tool. But let's look at it. How do I protect your assets if you don't use an annuity? We've got a couple different ways that we look at that. We've got custom notes, proprietary indexes that help protect those gains. If they go down, the worst I can get is zero. Most people like that, little less time frame involved with it. The other thing that I believe that we do very well with Market Guard are our tactical models. The models that move away and start to reduce your equity exposure when we have the headwinds that we're having now. So a 60-40 portfolio can adjust back down. It might only be a 50-50 right now. So that's the idea around it, where we don't have to sit here and say, I believe that things are going to be less. I would rather be non-emotional, mathematical, methodical movements on when the math says it's time to move the portfolios. So if you're concerned about what's going on out there, looking for ways to protect those gains, give us a call. Let us run that risk-reward analysis. Ask about how you can protect what you've made over the last 2 to 3 years, because the last 2 to 3 years have been some pretty good years. So give us a call on that.
And that phone number is 636-230-8824. 636-230-8824. Again, that's for that risk-reward analysis. You can always get more details online at yourmoneymattersstl.com. You know, annuities, they've come a long way from what your parents or even your grandparents had back in the day. I mean, back then, high commissions often benefited the seller more than retirees, giving the products really a bad reputation. Morningstar's analyst Don Phillips says it's time to rethink that because annuities have evolved.
People think of investing as a game, and who ends up with the highest pile of cash wins that game. But you really need to realize that investing is a means to an end. And things like annuities are something that fit into that and can be a very helpful part of giving people greater security. And to me, the whole reason that you help people with investing is that you give them that kind of security, that stability, so that they can know that their financial future is firm, so that then they can, go and pursue their dreams, do the things that really matter to them.
Okay, I see where he's coming from there. So where do annuities fit when the goal is stability and confidence, Steve?
I think for me, I look at annuities because I know that as soon as we mention this, there are people out there that grow horns. And I'm going to the fact of sitting here saying, give me the right tool for the right job. I'll have those people that'll walk into the office and they'll say, I hate annuities. And I go, I don't like most of them either. What kind do you not like? And then I get that deer in a headlight look like, what do you mean? What kind? You know, there's many different kinds out there. The four basics are single premium immediate annuity. That's when you give an insurance company your money and they're going to pay you a lifetime income for the rest of your life. Now, as Don said many years ago, if you prematurely passed, the money went to the insurance company. And people didn't like that. So the insurance industry has shifted the way that happens. There are period certains. There are different ways that they can do those. So that's giving your money to an insurance company. You've traded it for that income. It's kind of like your pension at work. You're going to get it. When you pass away, it goes away. But they have period certains. Then we look at ones that give you a specific rate for a specific period of time. Sounds a lot like a CD at a bank, but it's not guaranteed by the federal government. It's guaranteed by the insurance company. Give me X% for 5 years, 4 years, 3 years, whatever we go from there. Then we have the variable annuities, and a lot of people have not been happy with some of the costs inside of the variable annuity. The costs inside of it are basically to sit here and say, if they lose the money, we're going to play as if though you haven't, and they're going to have income riders on them. If you hear the word rider when you talk about annuities, think cost is about the easiest way to put. Think cost. Now you have the fixed indexed annuity. The fixed indexed annuity is not invested in the market. You cannot lose money due to market volatility. But depending on the product itself, it could have a strategy charge, caps, different things like that. So they're not simple products. So we start to look at it and say, how can we benefit from this in times like this? Again, I said the right tool for the right job. Well, let's look at one example. One example was Kathy comes in and she's got about $800,000 to about $1.1 million, and she's got a gap. Her Social Security income, her pension income, and her alimony are about $1,500 less than what her living expenses are. How do you cover that gap? Well, if you're in that situation, there's a couple ways you can cover it. A fixed indexed annuity with an income rider. That's going to guarantee that payment for the rest of your life. If you have a spouse, you can do it for both of them. We could cover it. Just take your invested assets, set enough aside, use the 4% rule. I like to add a little time in for those years that we don't want the market to go down to make sure my 4% is covered. Or we can let's just look at a stock portfolio with preferred stocks or a bond portfolio. That's other ways that you can do it. People usually ask, Steve, which way do you lean? I say, go to the one that I have to use the least amount of money to get. And I think that's important when we start to look at it. So if you're concerned about how you're going to replace your paycheck when you retire, call now. Ask about income planning. Let's look at all of the ways in which you can create that income, because there's only 3 things that are important in retirement: income, income, and income. And it's got to be after-tax income. Call, ask for that income plan. Allow myself and my staff to assist you in replacing your paycheck in your retirement years.
Again, find out how you can replace your paycheck when you sit down with Steve or a member of the team one-on-one. That's 636-230-8824, 636-230-8824. Big news recently for SpaceX stock. It's taking off after its public debut, and thousands of its employees are facing a problem most people would, quite frankly, love to have. What do you do with this life-changing money? The Wall Street Journal said one worker saw his shares soar past $21 million, but still hesitated. when his financial advisor suggested trimming that position after the IPO. So when someone like that walks into your office, Steve, with so much wealth tied up into one stock, how do you approach that conversation about risk?
Well, let's talk about a couple different things. I'm going to break it down into two. One, SpaceX. I get a lot of calls on that. I'm not recommending you buy or sell SpaceX at this time. I'm just going to say be careful, because I got a lot of the calls. SpaceX going to go from here, go to there. Well, it went way up those first couple days, and it's kind of come back down to reality here. And I feel that fear of missing out is what's driving a lot of people into, I'm buying this because of that. I like to look at it and sit here and say, why don't we give them a little bit of time to find out, is the valuation of this stock, can their income support it? Because that's how stocks values increases and decreases. But I think a lot of it right here at the beginning was the fear of missing out. Then they're going to have that drop, which they already have had, some of the drop. But when those people, like the person that you were talking about, if their shares were restricted, they have to hold them for such and such a period, then they can sell them. Usually when you hit that period, you also see a decline in a stock. So I'm not suggesting buy. I'm not suggesting sell. I'm just suggesting be careful of that fear of missing out. Now we start to talk about concentrated stock positions. Where I have seen that the most in the St. Louis market is with Anheuser-Busch, Boeing a few years ago, where people had large exposures to a single stock. I look at it when you get more than 15 to 20% in one stock, you want to start to be careful. The example that always gets used is Enron. People's pensions were tied to Enron. Their 401ks were tied to Enron. Their stocks were in Enron. And when Enron went down, everything went. And that's where you have to be careful of putting all your eggs in one basket. Depending on where it's at in your portfolio, if you currently have highly appreciated stock in your 401k account, there's a little deal called net unrealized appreciation that gives us the availability to move that out of your account with some tax advantages attached to it. So that's one of the things that a lot of people don't realize. I can move it out of the 401k to a non-qualified account and pay taxes on the cost basis, not the current value of the stock. So that's one of the things that we look at for there. But if you are in that position, then we have to look at it. How do we sell that stock? How do we sell it and keep your taxes as low as possible? Look at those lots and when you purchased it. Make the largest amount of capital gains in the part that you're holding on to. Sell the things with the highest cost so that your taxes are as little as possible. If you have highly appreciated stock, if you have a large concentration in one company, give us a call. Allow myself and my team to assist you on what would be the best way for you to loosen or reduce some of your exposure to that single company stock.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any government governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.